Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Dan Oliver. He is the founder and managing director of Mermican Capital. Dan has been on the show a number of times in the past. His a more complete bio is available at the Voice America Business Channel website. Thanks for joining me again, Dan.
Thanks for having me.
Really good to have you, and I know that your life is quite hectic these days with all that's going on, but I want to thank you so much for taking a few minutes to talk to us. I'd like to talk to you about your latest piece that you put out called The Slingshot. You noted that gold has shot up quite nicely since the March lows, but it's not just gold. It seems almost everything is on the upswing price-wise. Tesla, for example, you point out, has risen dramatically, as has Hertz Global Holdings, despite of its bankruptcy declaration. You relate a seemingly nonsensical price behavior in a lot of these markets. If you look at Tesla, for example, it's been a perpetual money loser. And the bankrupt company, Hertz Global, how do you explain what's going on now? These seemingly bankrupt companies that are worthless are the fancy of the investing public.
Yeah, so going into the March low, I've been writing about whether gold would have a big dip the way it did in 2008 or not. And my reasoning was that, as we all know, in the bubble that led up to the 2008 panic, the Fed was caught flat-footed. They responded over time with increasing amounts of programs. All have different names, but they're all one thing, which is printing money. And then of course the QEs came and it worked, quote unquote. It created a larger credit bubble. And so I wasn't quite sure how it would play out, but what I did was pretty confident about was that not only would the Fed respond much more forcefully this time because they'd been through 2008 and they had developed all these protocols to deal with credit collapses, but the market itself would second guess what the Fed was going to do at a much faster basis. So if the same thing happened, it would happen at a very, very accelerated pace. And that's exactly what we saw. In the paper I wrote at the time back a few months ago, I noted that all the programs that the Fed took a year to roll out last time came out in about 10 days and then some more on top of that. So the policy response was absolutely overwhelming. And again, the market, unlike last time, knew exactly what all this meant, which was tons of credit and money being poured into the economy. So they didn't stick around to ask questions. They started buying everything that wasn't nailed down, including bankrupt companies like Hertz. So I think it really is a function of the Fed has injected this new money, this newly printed money into the economy, and the economy's responding. One of the points I've been making in various venues is that these QEs are very different than the last round. The last round was a banking crisis caused by overcapacity, which is always the end game of the Austrian business cycle, when the banks over invest or over finance capital items, and then rents fall through overcapacity and they'll default. And so when the banks got the new money, the new reserves, what they did was what they usually do, which is go then construct new assets, which employs workers, it drives base commodity prices higher. You get that Keynesian sugar high, and you go like credit. And paradoxically, a lot of times consumer prices fall because as you get more and more capacity coming online to produce goods and services, the price of those things become less scarce and they go down. So all the inflation we looked for after the last QAs never really happened because the inflation was all in financial assets and construction and not in consumer prices. These QAs I've been arguing are very, very different because this wasn't sparked by a banking panic. That was coming along. As you know, all the problems in the market began in September. And even before that, actually, if you look closely. But this pandemic where the government ordered a shutdown. And so now these QEs are being done to finance current payments, so not investment in new capital items, but enabling people to pay the rents and the interest on the assets they already have. And so that's a very different thing. That's just monetary debasement. That's not a credit inflation. It's something entirely different. And what we see this is, in the CPI hasn't gone up much, but that's because 40% of CPI, you probably know, is housing, and that's been hit. And then transportation is 15%. That's always gotten crushed, so that's gone down. Meanwhile, food is going crazy. It was up 4% in the last reading year over year. So inflation. Say, hey, the Fed says there's no inflation because some prices are going up and some prices are going down, and it averages out to very little. But if you're living in the world and you actually have to consume things to survive, prices go up. And of course it is, because again, if people don't work and they consume the same, then and the Fed prints the money, give them the money to allow consumption to stay the same, then the only thing that can happen is prices can go up, and that's what we're seeing.
We're definitely seeing prices of the things that you have to stay alive going up.
That's right.
And a lot of the other things. But Wall Street seems to take the CPI at pretty much at face value, and it says there's no inflation, and the Fed keeps pumping more money in. There's no inflation, they say. What could cause that to change? I mean, people seem to be content with low interest rates. Maybe the answer is because there's really nobody really saving their money anymore and expecting some kind of a decent yield. They're just really looking to go out and buy assets and assume on asset appreciation will get them what they need. Is that what's going on?
Well, this is one of the problems you have living in the world today, which is on the one hand, you've got to have money. You want to save money because when these panics come along and maybe you lose your job, maybe your asset prices get crushed, you need some money to live on. On the other hand, you know that money long term is going down in value big time because they print less money and they promise to print more. And again, this is really last time wasn't money printing; it was recapitalizing the banks. This really is money printing. I should say, really, it's actually both. I mean, the Fed is of course injecting this money straight into the economy, but one of the things they've done also is to buy enough Treasury bonds to put interest rates way down. And one of the things that happens is there's an enormous housing refinance boom, right? And it's just a function of credit of interest rates. I mean, the amount of money you can. People don't think about when they buy a house or an apartment what it costs. What they think about is what's the monthly payment going to be.
Right.
So as the rate goes down, that same monthly payment buys you a more expensive house or the same house just at a higher price. And the seller then gets that cash from the bank, right? Not the buyer. The buyer hasn't really changed, but the seller gets all that extra money that the lower interest rates creates that higher price. And then what do they do with that money? They generally don't consume it. They go buy stocks or a different house or other things, other assets. And so that's the way the private bank system, not the Fed necessarily, but the Fed enables the private bank system to create money out of nothing through asset sales, which then juices the asset markets as well.
You made a note in your piece about how the Fed has actually done away with, as I understand it, has basically done away with reserve requirements. They used to be traditionally something like 10%, except for certain assets, certain like treasuries and so forth. Some of the more safe instruments would not have that kind of 10% reserve requirement. But generally, loans were reserved at 10%. And now they've basically, if I understood what you said in your article, the Fed has actually just done away with reserve requirements so that there's no limit on the amount of money that can be created, essentially.
That's just stunning. I mean, the textbook model, which reality more or less followed, was that, as you probably know, if there's $100 of new cash in the system, you deposit in the bank $100, and the bank can lend out only 90% of that because the 10% reserve requirement. So they lend it 90% to me, but then when I get the loan, I get cash in my account. So I deposit in a different bank, and the bank says, hey, we have $90 of new deposits. We can lend out 90% of those deposits.
Right.
So lend out $81. And that's the fractions of process, and that $100 turns into $1,000. That's why you almost have to think about it each time you say it because it's so bizarre and crazy.
Yeah,
but
it is.
When you deposit $100, the banking system as a system lends out 1,000, and that's determined by that reserve requirement. If you reduce the reserve requirement to 5%, then that process creates $2,000 of credit off of that $100 deposit. And so if you eliminate reserve requirements, then it means that the banks can effectively create infinite amounts of money. Now, there are other things to constrain them. I mean, the banks don't want to lend against things that they're going to have a guaranteed loss. So if you walk in the bank, even if they can create infinite amounts of money, if your business plan is no good or you have no credit, they won't lend to you. But they have the ability to lend an infinite amount of times. And one asset that is, on a nominal basis anyway, completely guaranteed are treasury bonds. And so one reason why the Fed likes low reserve requirements for things that they like mortgage-backed securities and treasury bonds, is to say, look, these things have almost no risk, and so the banks can buy unlimited amounts of them, and the money that they lend against it gets recycled into the same market. And so basically it means the federal government and the mortgage-backed security market can borrow unlimited amounts of dollars. And that applies to any securitization structure. So if you look at the CLO market, all these structures that now define the banking system as a system is the shadow bank system. Now literally have that money creation machine has absolutely no limits to it, and it's another reason why the amount of money creation is stunning. I'm sure you've seen the statistics, the growth of M2 year over year. Do you do the number in front of you? I don't, but it's the highest since after World War II. It's more like 25%.
25%, yeah.
I mean, it's just a stunning growth, and the apologists say, oh, well, it's fine because all the money sitting in bank accounts is not actually being used, and the economy isn't going to push prices prices up. But of course, I mean, that is there now, right? But the money's there. So the second people figure out, oh my goodness, prices are going up, how long are you going to sit that much cash? Again, you always have some cash on hand for emergency purposes, but if you get a lot of cash and you see prices running away from you, you're going to take the cash and go deploy it and accelerate that trend.
So this is a slingshot. There's no reserve requirements. There's nothing to hold back amounts, an infinite amount of money that can be created and will be created. And this time, as you pointed out, as Alistair McLeod has mentioned on this show, the 2008 was a financial crisis. This is a crisis, in the main economy. And so what you have are lots of people that aren't working. So you have the supply side taken away to a great extent. And yet you have money that's going into the people, to pay their rents, money created out of nothing. And so this is what Alistair would also argue, that we're headed for some very dramatic inflation.
Yeah, I said that dramatic inflation. That's the point, is that in a free market, prices would have plummeted because demand went down. That's what happened, supply and demand. The supply didn't change much, and the demand, got crushed. By legislation, you can't work. You can't, if you don't produce things, then you can't acquire things. So to me, it boils down to Say's law, which you may recall, is you demand through your production. So you produce something, and then you sell that production for money, use that money to buy the thing you want. And so it's your production that defines your demand. And if you think about it, if you take Say's law and apply it across an economy, what it really says is that you can't consume more than you produce. That should be pretty basic. The Keynesians can't figure it out, but that's a pretty basic thing to say. And so when you order everyone to stay home and not produce things, well, then you can't demand things because you haven't produced anything. But again, the Fed has mandated that no one shall suffer, and so they're going to print as much money as they have to allow people to consume what they were doing in the past. But since you're not producing things, the only thing that can happen is prices have to go up, and that's why I'm so certain that we're facing inflation this time. And there's another point. I think the market's telling us this, and that is looking at silver prices. People generally refer to silver in the markets as just gold on steroids, with high beta gold, and that's not at all accurate. If you look at the function of gold and silver throughout the ages, they had very different functions. Gold was the money of capital, so when you had a large transaction like buying a ship, a capital asset, or ransoming back your king, or something that required a huge amount of money, you use gold. For more colloquial transactions, going to the marketplace and buying food kind of thing, you use silver or copper. So silver was a transactional metal, and gold was the metal of capital. And so in the 1930s, when we had that banking crisis, there was nothing wrong with the dollar. The dollar was very solidly backed by gold, by 90-day commercial bills, and by federal debt that had almost no debt because Andrew Mellon had paid back all the debt during the 20s. And so there was no transactional problem with the dollar, and silver got crushed. Gold did well because there was a capital crisis in the banks, but there were no transactional issues, and so the gold-silver ratio blew out to enormous amounts. You look at the 70s, and you had a credit bubble that was resolved through inflation, and so you had a capital problem, i.e. Your capital was being eaten away by inflation, so gold did very well. And you also had a transactional problem because the money of everyday use was depreciating so quickly. So silver did incredibly well. And so we're looking at the next currency crisis. I've been saying for a long time that it is possible you could have a deflationary credit collapse. The Fed sat there and did nothing and let everything melt down, in which case gold would still do well, silver would do very badly. So it wouldn't be gold on steroids, it would be different things. But that given the Keynesian consensus, the chances of that happening were very, very tiny. And of course, the Fed's going to print and print and print and print until the machine breaks. And in that case, that is the situation where silver outperforms gold, and that's what we're seeing. If you notice, silver did underperform gold big time during the crisis, as it should have, because things were melting down. And now we see silver breaking out, and that's a signal. That's the market telling us that inflation is coming, and it's coming soon, and it'll be big.
Dan, with the time we have left here yet, I'd like you to talk a little bit about the South Sea bubble. You talked about the Cantillon effect, and maybe just a little bit about the South Sea bubble, because I know Alistair McLeod has talked in the show about the parallels between what he sees anyway, the parallels between what happened with John Law's South Sea bubble and what's going on now. Can you talk about that a little bit?
Yeah, sure. So John Law was a Scottish adventurer who created the Mississippi bubble in France.
I'm sorry,
yes. Happened a little later in England, and And he basically set up the first modern banking system where he replaced gold and silver that was in use at the time in France with banknotes. And the banknotes were first backed by gold and silver and commercial credit, which are very solid. And then he went around and financed all sorts of speculative enterprises and unpayable federal debt, French sovereign debt. And they created the first large modern credit bubble. And Cotillion was one of his partners in this, a banker, and Cotillion was a very Murray Rothbard said that he wrote the first modern economic treatise, which is probably correct. And one of the things he noticed was that the people nearest to the bank got the money first and were able to spend it before prices rose. He actually described this somewhat differently. He described it as if you discovered a gold mine, because again, gold was the money, the real money at the time when he was writing. You get very rich, and the things that you bought with the new gold you'd found, you could buy at the then current prices. So you would change production because you said, okay, I want beef instead of rice or whatever you were reading before. So the beef farmer gets richer because he gets the money first before everyone else does. And so the money flows into the economy in a certain direction. And the last people to get it are people on money contracts like domestic servants, he says, and landlords who have long-term contracts. Now, he talked about gold and silver, but of course, the reason he came up with this idea is he saw it happening in France where those nearest the bank got the money first. And this is why in our country bankers are so rich, because they get the money first. And the Fed prints the money, creates the money through the process, and then the fractured process creates money in the banking system, and the bankers get it first, and they get to spend it before prices have adjusted. And the next folks to get it are people who own assets, because this money floods into the asset markets. That's how they print their money, right? Is they lower interest rates, and that creates higher asset prices. And that's why, especially older folks who own most of the assets in this country, it goes to them next. And then the last people to get are people who are work for wages and money contracts and who are on a fixed rate income. And so that they get really screwed. And so one of the things Cotillion noticed is that you get this huge bifurcation of rich and poor based on how close you are to the entity, be it a gold mine or a central bank creating the currency. And again, that's exactly what we see in our country, is that we have this huge bifurcation between these two groups.
Mm-hmm. No doubt about it. But Cotillion at least was smart enough to recognize there was a problem. John Law wasn't. Cotillion went short.
Well, that's right. He had a bank. People deposit their shares in his bank, and he sold them. So he basically shorted his customers' shares, took the cash, converted it to gold, escaped. I think to Holland or Italy. I think. And then the thing crashed, and then he bought back the stock at zero, his customer stocks, and he returned to them, worthless. And they thought he had abused his charge, and they chased him around for 10 or 20 years. He became very rich on this, and then he died in mysterious circumstances in London. His house was burned down, and there's my speculation as one of the people he'd done this to. But in any case, yes, no, Law believed in this bubble like Bernanke, like the current central bankers, and he lost all his money and had to escape, flee France disguised as a woman. And the real guys who understood how it worked, Cotillion became multimillionaires. Didn't make a lot of friends, but they became very rich in the process.
Dan, how will this end? I mean, if the market was allowed to exist, we would have a heck of a correction. That's putting it mildly. Interest rates would rise because there's a shortage of real capital. The Fed can't allow that to happen because as soon as they've wanted to sort of unwind the balance sheet, but they can't, because as soon as they do, the thing will start to implode. So what happens, and what could cause interest rates to rise right now? What would be a trigger that could cause it to rise?
This is just what Mises wrote about. Constantly, which is that they're in a place where if they let interest go higher, you'll bank up the entire private equity structure. You'll bank up the government. You'll bank up the banks. Everywhere will go bankrupt. They can't do that. If you don't allow that, the only way to prevent it from happening is to accelerate the money printing. And if you do that enough, then the currency collapses. And those are your choices. And when you look back, particularly at Weimar Germany, we're not there yet, but we're heading in that direction. They kept vacillating. They would say, "Oh my God, the markets are unhinged, inflation's unhinged. Let's tighten up." And so they would stop the printing press. They'd slow them down. Everyone would go bankrupt. There'd be a huge crash in the markets. And they say, "Oh, this is too painful." They print faster. So they got involved in that, and that's exactly where we are. Mm-hmm. I mean, it's a much longer process because we're not down the vortex quite deep enough yet, but we see this. They stopped printing money the first thing Bernanke did as a chairman when he came in was slow down the money printing, and then 2008 happened, and he had to accelerate it. And then what did they do? The Fed do for the last couple of years? They were slowing down the money printing. They were trying to lower their balance sheet and increase rates, and it worked. The economy handled it for a year or two, and then the wheels popped out, and they have to accelerate the money printing. So this is the process we're on, and it's going to get more and more intense, and that's again why you can't ever be sure what markets are going, because one of the features of inflationary economies is volatility, and volatility will increase, and you have to be aware of that. But there's no way out for the central banks of the world.
Yeah, I mean, if you're on the Niagara Falls, approaching the falls, there is a point at which you cannot turn back. It's inevitable you're going to go over the falls. You said we're not at that point in the vortex yet where we're...
Well, we're heading there. We're heading there.
And,
to your point, what if rates went to 10% or 20%, 4% rates tomorrow? I mean, what institution would be left standing in that environment? What company wouldn't default? I mean, there aren't any. I shouldn't say there aren't any, but the vast majority of large structures in this economy would collapse immediately, and the politicians who are all paid off by these consummate businesses simply won't allow it. And so the only way you prevent that is by money printing. So we're there. I mean, we're there.
Money printing faster and faster. I mean,
That's right.
It's more and more faster and faster. Exponential growth in the money supply, in the creation of money, and that's the slingshot. That's what you're talking
But
about.
not steadily. They'll try to rein it back at various times, and then everyone will be thrown off.
But they won't be able to, because right now with a 25 $trillion debt load now the U.S. has, imagine just a 1% increase is 250. It's just a 1% increase, Dan. It's really frightening.
If we have time, Jay, just one thing I want to mention too is the Fed's talking about yield curve control.
Yes.
Which is in the 40s when they financed World War II, and the idea was they said we the Fed will keep rates at I think it was 0.5% short-term rates and 2.5% long-term rates, and it worked, quote unquote. And there are Fed papers, modern, recent papers saying, hey, this worked, we should try it again. Well, the difference was that in a war, spending spikes in the war, of course, and then it comes down again when the war ended, which is what happened. Now it never went down to where it was before, and it grew ever since. But it did come down a lot, and also the Fed's balance sheet in 1942 was 84% gold. Mm-hmm. And so in other words, which was 25% of the known gold supply on the planet at the time. In other words, it was a hugely rich country, and if we wanted to squander our capital, controlling rates, we could do that, especially in the context when spending was to come down after the war. Right. This is entirely different. We have a bankrupt Congress, we have a bankrupt Fed, and the spending is not a one-time thing. I mean, the stimulus COVID is, but if you look at the long-term effect, it's straight up with all these entitlement programs, and so there's no relief in sight. And so if they try that, they'll have to buy the entire treasury bond complex, which is more or less what John Law did at the end of the Mississippi bubble, and that's what created the last big jolt of enormous inflation before the whole thing unraveled and collapsed.
Yeah, indeed. And Dan, I might just, in closing here, just mention that one of your earlier articles that you wrote, you showed a chart that showed the volatility of gold in the Weimar Marks during the hyperinflation in Germany.
Right.
And as you mentioned just a minute ago, there's likely to be a lot of volatility, but you got to hang tight because in the end, gold won out. Gold is real money.
Hang tight and don't lever yourself up too much because then you can't hang tight.
Don't lever. Yeah, exactly. Don't lever. And those of us who have been around from the bottom up are in much better shape than the Johnny-come-latelys, perhaps.
That's right. That's true.
Dan, I want to thank you so much for taking your time to talk to us. These are I think, very, very important discussions, and I hope and I'm sure our listeners will benefit. So thank you very much for being with us once again.